All right, everybody, thank you as always for listening and watching. Today we have another great edition of Let's Chat with Other Retirement Planners. Today's a little different, a little special. We have a tag team, David and Mary Oransky from Laminar Wealth. How you doing?
We're good. Thanks for having us here, Andy.
Yeah, thanks for coming on. So I met you two virtually, at least through Zoom, about a year ago. I'm going to say maybe more. And then a month ago, had the pleasure of meeting you in person when we were at a conference, if you want to call it that, in St. Louis, which is where you're from or thereabouts. So it's great to finally meet you two after knowing you virtually for so long. So
absolutely, we enjoyed it.
Yeah. So can you give a little quick background about yourselves, your firm, what you do, how you do it, et cetera?
Yeah. So I founded the firm a little over 10 years ago, Laminar Wealth. Leading up to that, I studied accounting and economics in college, worked for a Big Four accounting firm, got my CPA license, realized I would much rather spend time learning about personal finance than corporate finance, and left for a wealth management firm, worked there in Silicon Valley for a while. And then when we moved to the Midwest, Mary's from St. Louis, that's when I went out on my own and started the practice. And then Mary joined me a few years later.
Yeah, and I am just naturally a planner. So I'm a suburban mom with a minivan, and I've got like the towel in the back of my car to wipe down the slides after a rainstorm at the park. And I'm just, always kind of organized and prepared and always looking ahead to what I want to do and other things. So for example, I love Pilates, and it's mostly because I go and there are these women who are, a few decades older than me, just absolutely kicking my butt. And I'm sitting here, my youngest is 3 years old, but I'm already thinking about the grandma I want to be. And I'm like, I want to be like them when I'm a grandma. So sort of always putting myself in that position. And that's what I think is so cool about financial planning, is being able to look ahead and, see the choices that our clients have made and where it's landed them in the long term. And then also sort of just helping them to make good decisions into the future. But I actually got into finance because of David. So in college, I studied biochemistry, and I guess we should mention that we are married. In case
it wasn't obvious.
But so it was like maybe newlywed bliss, because it was about a year after we got married that David was starting Laminar. And that's when I first learned about financial planning. And David encouraged me to take some financial planning classes. So I, got the formal education there, and then I started working at a larger firm, and I got some experience, became a CFP. And as we were having kids, and I was wanting more flexibility with my time, and Laminar had grown enough that, David and I joined forces and haven't really looked back since.
Great. And what's the structure of your firm? Like in-person, virtual, mix of both, and now you're mostly or solely retiree focused?
Yeah, so we are, we're an independent, fee-only fiduciary firm. We are working primarily with retirees who have at least $1.5 million, which I think is just important, because I think a lot of the questions that we talk about, it comes with the framework that the clients that we work with, have, a substantial amount of assets. We are located in St. Louis, Missouri, but most of our clients are not in Missouri. So we work with people all around the country. So definitely virtual. And as far as fees go, really similar to you, we charged fixed fees for our services. And that includes everything from investment management, financial planning, tax, retirement planning, all of that.
Okay, great. And I completely forgot the dad joke. I'm sorry. I don't know where my mind was.
Oh, yeah.
I wanted to ask you, what does a grape say when it's squashed?
I would think it whines, but I don't know.
Oh, you know what? It does whine. It lets out a little whine. You ruined that. Hold on. So I got to back up one. Okay. This is a statement, not a question, but I accidentally ran into a guy who sold me an antique globe. It's a small world. The globe is good. All right. Yes. Thank you. All right. Moving on. Now that that's done. So, all right. Discussed your firm. Now we get into some general sort of your experience and what you've dealt with in working with folks, kind of things you've seen and witnessed. And what do you think is an area of retirement planning that many consumers overlook or don't give enough consideration to?
Yeah, so I think I want to answer that one in conjunction with your next question, which is an area that they give too much attention to, because I think it's kind of the same answer for both of them. And it's maybe not like one particular issue, but it's when clients get so focused on any one particular thing, like they're either giving it too much attention or they're completely disregarding it. A few things come to mind just that we've seen over the years. So it could be people maybe are focused like too much on interest and dividends when it comes to investments. They're too focused on the Roth conversions or, I bonds, or, we see like one thing in particular, and we see this both with advisors and with clients that, maybe they've like listened to a podcast or they've read an article and they're just get really focused on the one thing.
Yeah, I think you want to make sure you don't miss the forest for the trees. Like so much of the value of financial planning is like integrating it all. Like, tax planning shouldn't be some discrete part of the plan. It should be the thread that runs through everything. And getting all of that together, whether it be taxes or investments, like ultimately what you're trying to do is maximize your wealth after all fees and taxes. And so, an example that often comes up with taxes, especially when we work closely with a lot of CPAs, is the generic thing there is they want to focus on minimizing taxes this year. Our focus is how do we minimize taxes over your lifetime? And so, integrating it, I would say.
Yeah, that's really important because, as you know, all the stuff we do one thing doesn't take the front seat. Maybe any given year, certain things may have more sort of prominence over other areas given life circumstances and whatever. But for the most part, this is truly a packaged, cohesive, tied together service and offering where there's lots of different things we do. Nothing is necessarily more or less important than the other. Yet many people, especially with investments, I'm sure you've seen this, like a lot of people think an advisor is just picking the hot stocks or something, or Roth conversion is, the buzzword du jour that many people put a little too much thought, consumers, I think, put a little too much thought into. So it's important to consider those things, but realize they're part of the bigger picture, right? Right,
exactly. Yeah. Roth conversions are great, but it's not because they're Roth conversions, because it reduces taxes over the long run. So totally. I think the other thing that comes to mind for me is precision. Like financial planning is a bunch of calculations and people love to know, okay, well, what if I change this? Then how much more can I spend 20 years from now? And it's like, directionally, we can tell you that, but let's not get hung up on the precision here. And it's better to be like approximately right in the direction we're going rather than precisely wrong. And I see that a lot with clients and advisors, honestly, where they're just kind of calculator operators and they think that the output of that financial plan is exactly what's going to happen. And it's like, no. You got to look at this from many different angles. And we're trying to triangulate around it's somewhere in this area. Like, we don't know how it's going to turn out, but we can eliminate hopefully the bad outcomes. Like what could go wrong and how do we get rid of those things? And what we're left with is hopefully a high probability of a successful plan.
I'm glad you said that. I think that's a great quote, something along the lines of it's better to be, what would you say, mostly right?
Approximately right than precisely wrong. Yeah, that's not I don't know where I picked that up, but I love it too.
I heard that floating around somewhere as well. And that's true. And it's easy to get hung up on the details and trying to over optimize and really quantify everything, especially since there's software that tries to do that. And advisors, like you said, advisors alike are sometimes at fault of putting numbers into this calculator, spitting it out and says, hey, look, I can save you $237,000.15 in taxes over your lifetime per this calculation. It's like, we know that's wrong. Directionally, we think it's right. Like, yes, taxes can be saved, but the exact amount, I don't know, time will tell. It's important to stay flexible and, adapt as life in the world plays out.
Yeah, exactly.
Great. Major differences in planning between single folks and retired people. Single and couples. What do you see in your experiences?
So I think there are a couple technical things. I kind of struggled to answer this question because it's not like we have a separate process that, we do for single people versus those who are married. But, I think there sometimes are technical things that end up being a bit different. So, we think through long-term care planning. If you're single, it might be easier to tap into the equity of your home for your care versus if you still have a spouse who needs to be staying in the home, things like that. A bit more thought, I think, should go into Social Security claiming strategies just because you have more options on what to do there. But I think for us, a big thing and that we do in our firm is we do life planning. So we both studied under George Kinner to do life planning. And so we get to know our clients really well. And I think one of the roles that we can play for single people, or that we see that sometimes that's different than when they're married, is they don't have that thinking partner. Like, they don't have that sort of built-in person that they can, they just have something on their mind before they go to bed at night and just kind of share that back and forth. So I think that's just a difference that we see as they make decisions around their finances.
Can you talk more about the life planning thing? I'm sure a lot of people listening aren't familiar with that, or George Kinder for that matter.
Yeah. And it can mean different things to different advisors. There's lots of different kind of schools of thought. I think George Kinder's often thought of as kind of the forefather of the kind of life planning movement. And then there's been various, spin-offs and different methodologies there. But the way I like to think of it is like a financial plan is, a puzzle, and it's putting all those pieces together and integrated, to get the whole picture. But the thing that's so often forgotten is, what are we building here? What's the picture on the front of the box of why we're putting all these things together? And that's what financial life planning is to us. And so we start through with the process of, following George Kinder's methodology a lot, which is kind of getting to know what's really important to them. Imagine you had all the money in the world, like what would you do? And that's probably not their financial plan. Most people have dreams that are beyond their financial means, but it kind of gets people thinking, no constraints here. Like, what is a full life to you? And then getting into, all right, if you only had 5 to 10 years left to live, what would you do? What's on your bucket list? What are those things you want to make sure get done? And then kind of getting down to, if you only had 24 hours left to live, like, who did you not get to be? What did you not get to do? And it's less about the bucket list there, but ultimately, like, what's really important to you? What does your life need to have meaning? And at first, that doesn't sound like it's anything to do with finances, but pretty quickly you realize, money is often a proxy for time, and there's trade-offs there. And I think for us, what it does, in addition to helping us to know our clients really well, is so much of the financial plan, there's a lot of assumptions that go in there, and we can't possibly run every single nuanced assumption by the client of what you do here. So we need to imagine, like, if they had all of our knowledge and skills around financial planning, like, what would they do in their own life? They're the master of their own life, but they don't. And so it's easier for us to try to say, if we were in their shoes with all of our, financial planning knowledge, what do we think they should do? And that helps us bring to the table, I think, better solutions, or a shorter menu of options of, like, here's the options. We think this is probably the right one for you based on this. And I find generally that the financial plan connects a lot more. It's less of just the calculator and more of a plan of it, and it speaks to something.
I'm curious. It sounds great, and I agree. But are there people out there? I guess I'm singling out like the engineer-minded folks who just flat out poo-poo that as like black magic or something, and say, don't talk to me about that soft stuff.
We've got a few examples.
So it's actually, it's pretty fun, because there are some people who, so our process is we have an introductory call with someone to see, like, objectively if we might be a good fit. And then the next step is to have this life planning meeting, and we send them these questions ahead of time. And it's usually with a married couple where, like, one person is much more comfortable with it than the other. And it's pretty funny to see, because what we'll do is we'll often kind of start with the person who didn't answer the questions, and we'll just, like, walk through it with them first. And they just start opening up. And by the end, like, I can think of one, very serious physician who, he had like a very serious personality. And at the end, he's like, where did you get these questions? And how did you do this? And, like, this is so cool. No one has ever done this before. So I'd say by the end, most of the time, they're, like, a lot more open. They've had a really good experience with it. And also, and we kind of talk about this later, but, like, who we limit the number of clients that we work with. And so we're only working with clients that are really good fits for our personalities and our firm. And at the end of the day, if you're not kind of willing to open up and share those details and have a really deep relationship with us, then we're probably not a good fit for you too.
Right. And vice versa. Yeah. Sorry, go ahead.
Yeah, I think that's right. I'm trying to think if we've had anyone that's gone through that initial meeting and has regretted it after. I think there's definitely some people that are like, there's no way I'm answering those questions. Like, I just want you to manage my money. Here's the details. I'm not telling you anything more than I think you need to know. Like, go make this successful for me. And those, I mean, if you're just an investment manager, maybe you can do that, but I don't see how we could do our job well if we didn't get to know them. And there's different ways to get to know people. We've just found life planning gets you there faster and more deeply. but we don't have, beyond those initial questions, we don't have like a lot of exercises surveys that we ask them to fill on a regular basis. To us, it's again that thread that goes through everything. Now that they know that they can bring those questions and concerns and the things that are important to them to the table, and that we're already kind of aware of that, as we're going through planning years from now, like there's already that relationship established, and that we know the purpose of this isn't just to get more money, although that's often part of how we get there, that like, what's it ultimately for? Yeah. And I like what you said, Mary, about fit. Like you try to feel out, is this going to be a good relationship? Not just, are you good for them, but are they good for you? And you have an intentional sort of capacity around the number of people you want to work with. That means a lot. And in a lot of firms, especially the larger national names out there, like anyone who can fog a mirror is going to be a client, right? Or can be a client. But when you have much more attention and focus with what you do, and it's a mutually better fit, I think it's just better for everyone, client and advisor alike. So it's Absolutely.
Really good to see like my firm, your firm, all the other people we've so far talked with on this podcast. They're small, they're intentional. I think relationships are that much stronger, better, thorough, et cetera, because of those things. So I'm not sure where I'm going with that, but I'm clearly biased in saying that because I'm fully bought into like the small intentional practice idea. But
you'll get a much more personal experience with a smaller firm that only works with a limited number of clients. Both because they're serving fewer clients, there's going to be less turnover. They're more invested in the business and the relationships rather than just a job. I think it's alignment of incentives there.
Yeah, definitely.
I know the other thing it does for us too is it allows us to be really proactive with our clients. So we're like not jumping from meeting to meeting. Mm-hmm. We can be, we can be really proactive, not just reactive. And then we have the time on our schedules to do things we enjoy, both personal and professional. And a lot of which is just, being passionately curious and being able to like research these topics that are applicable to all of the clients, in advance. So I think there's a lot of benefits both for the client and for the advisor to, serving a limited number of clients.
Yeah, 100%. All right, next question. Do you think there are some people who should do their own planning, retirement planning, et cetera?
Yeah, absolutely. I mean, that's how I got into it. Although I went to school for accounting and economics, I wanted to, my initial interest was my own personal finances. And Mary didn't even go to school in a finance related field. Obviously she's smart, she's a biochemistry major, but it was that interest. And so I think, as long as you have the interest and the aptitude to learn it, I think you absolutely can. I think when I imagine most of the listeners are retirees, I think one consideration there is like, is there going to come a time when you no longer want to or able to manage your finances? And do you have some sort of transition plan? So are both spouses really into it, in which case there's some backup there? Or do you, should you engage with maybe it's an advice only plan or probably not us, that you can bounce ideas off of to kind of fill in some of those gaps or have a sounding board. But I don't think they're, especially in this day and age, like none of the information, we're not the gatekeepers to information. So like it's all out there. If somebody wants to do it, I think that's great. And there's awesome communities out there. There's lots of good podcasts and resources like, your group. Bogleheads is a great community for people that are doing it themselves. Like, I think, yeah, definitely. And I think it's actually funny because we don't work with DIYers typically because we're doing investment management, or I guess really at all. We used to do some hourly work back in the day, but we've got some of our best referral sources are DIYers that know this stuff really well and are going around trying to convince everybody they know to do their own investments and own financial planning. And ultimately some people say, look, I just don't want to do it myself. So who do I talk to? And they're like, oh, well, go talk to Mary and David. So it's kind of ironic that it works out that way.
Yeah. Yeah. I think, like you said, this information's out there. We're not doing any magic with it. We're helping pull it together and, customize it for individuals, et cetera. But I think lots of people are very willing and able to do their own planning. To your point, the issue for many people eventually comes to sort of diminished capacity down the road. Yeah. Or in the case of a couple, one spouse is fully hands-on with this, the other one wants nothing to do with it. What happens when that spouse who's the hands-on one is no longer in the picture for whatever reason? Right. So those are some of the things to sort of think ahead, where maybe a relationship could make sense sort of in advance of one of these things happening. But this isn't to say, no, this podcast isn't to try to sell everyone and hiring an advisor. Far from it.
Right. Exactly.
So good points. All right. If people are looking for an advisor, what questions do you think they should ask? What should they look for, et cetera, when trying to vet people?
Yeah, I mean, I think you're looking for someone who's going to be objective and independent, which is maybe actually easier to screen for. Are they fee only? How are they charging? Although we charge, flat fees, we're somewhat agnostic. And I don't necessarily think that people that charge AUM are evil. I think you need to look at what is the total amount you're paying and what are the incentives that creates. And I think part of the reason when I started the firm, it was AUM. We switched a long time ago to flat fees. But part of the reason was I never wanted to, as we're discussing, should you pay off your mortgage? Should you roll over your 401k? Should you do this? That any of that would, in that instance, change my compensation. I just wanted to neutralize that, conflict of interest immediately. So that was our initial interest for flat fees. I think the other piece, though, is making sure, they're competent, both generally, but also for your specific needs. And I actually think that's in many ways harder to find. Like there are designations, right. CFP, CPA, CFA, and a whole bunch of other ones, which can be good for setting that kind of baseline of like, can you at least meet this? But I know a lot of people who are objective and independent, but not who I would trust running the financial plan. So you kind of need to find both. And I think you've got to, talk to the advisors that you're interviewing, run your scenarios, by them, see how they think. And does that align with your needs, but also your values and philosophy? Because some of this stuff is philosophy. It's, it's first principles. It's not right or wrong. It's just, how do you view the world? How do you view this? And is there alignment there? And as long as there's alignment at kind of the axiom level, then the strategy you can debate and discuss and figure out the right way to do it.
Yeah. And I actually take most of our intro calls these days. So along those lines, like things that people ask us or that we start to see, like issues that maybe this isn't a good fit. I think it's important to ask about investment philosophy because, if someone's going to be managing your investments, like that's a cornerstone thing. If you're, want to beat the market and do all of those things, then, you probably shouldn't hire someone who has a passive investment approach. Other questions that I've heard a bit more recently is, and I think important, who's doing the work behind the scenes? Like with all of these smaller, firms like ours and things like that, sometimes we can't do everything. So it's like, what pieces are you outsourcing? Who's actually doing the work behind the scenes? And what does an ongoing relationship look like? I've had more people asking me just based on experience with other advisors too, like, how often can I meet with you? Just like, how do I have access to you and things like that? Yeah,
that's actually an interesting one because this idea of a service calendar has become very popular in our profession. And I think it's good. Like we have a certain cadence to our year of when we meet and when we do this. But we've had several intro calls where people are like, but can I meet with you outside of those dedicated meetings? Like, what if I have a question? Right. It's like, well, of course. And they're like, well, that's refreshing. And I'm like, I guess there's advisors now that say, I only meet on this one day a month. And if if something happens in your life that doesn't align with my schedule, then tough luck. That's not how we are. Like our service calendar is to be proactive. Inevitably, we also have to be reactive to things that come up in our clients' lives. And by working with a limited number of clients, it's easier to do that.
Yeah, and in some other firms, larger firms or firms that have certain aspirations, like to your point, there's a cadence, there's a formal meeting cycle, let's say twice a year of meetings where you get to meet like the main decision maker, but then any other thing throughout the rest of the year, you call up or email, you're going to get the junior person, and not to say it's a bad thing necessarily, but like there's going to be a gatekeeper of the admin assistant or the junior person who you're going to get to. It may be more work and effort to try to get directly to the head cheese at the firm, right? Which, to be fair, if your questions and concerns or issues can get thoroughly addressed by the admin or the junior person, so be it. But if I'm the client and you're paying, especially you're paying a lot, right? You kind of want access to the one who's really making the decisions. Well, that's my view at least. But.
Yeah. Some questions are just straight answers. But a lot of the questions are like advice, like they want, how are you thinking about this? And, I think that's also kind of the value of having, in a way, two advisors in every meeting is, although Mary and I are very aligned, obviously, with like how we think about things, it's not that uncommon for us to be thinking through a scenario with a client and Mary being like, actually, that's not how I view it at all, David.
Right. So, what do you do when you dummy? No, that's not it. Right. Got it. All right. This next one is a favorite of mine. I think about it more than I should, but can the quote unquote value of good advisory and planning services actually be measured?
Yeah, I think about this too, because I think this is also one of those areas where people get really focused on one element, because absolutely there are certain pieces where you can quantify value. If someone's got all their cash sitting in a, big bank account that's earning, 0.01% interest, and you recommend moving it over to a high yield savings account that's still FDIC insured, that's quantifiable value. There's certain tax strategies that you can quantify the value, but a lot of these things are directional or trade-offs, and where I can say, this has a positive value into the future. I don't know what it is. Like, I can approximate the magnitude, but I would never give you a number because I wouldn't want you to hold me to it. And I think the other thing is, even if an advisor could present value all their advice and say, this is how I earn my keep, therefore I'm worth this. Well, what if another advisor does all those same things but charges less? Like, they forget about opportunity cost. And, but this is the beautiful thing about price and value, like that, old, saying of, value is in the eye of the beholder. Like, that's absolutely true. And the beautiful thing about markets and price is all you need to know is what the price of something is. And do you feel before the fact like that I would derive more value than what I'm paying? If that's the case, then there's value there. Yes. But people will place value on different things. Like, I think some of our clients do place a lot of value on the investment management. That's great. Others don't care at all. And I think from our standpoint, we don't really care which elements of our service offering they find most valuable. It's that on the whole, they think it's valuable, and that we think it's, valuable and worth our time too. And where there's a meeting there, that's trade. And that's where, that's where the magic happens.
Exactly. Yeah. There's lots of value in what we do. I'll never say there's not. Trying to figure out exactly how much it's worth is hard. Some things can be measured. Some things are completely up to the individual and sort of subjective areas and emotional areas that they may place different values on.
Yeah. And that's the great thing about having advisors that charge different ways. Like,
right.
Because you can pay for where you see the value and find someone who aligns their fee structure in that way.
Yeah, I think practically this typically comes up in two different places. There's sometimes, DIYers that keep being told that they need to hire an advisor, they're leaving so much money on the table. And so there it's trying to compare, like, well, what strategies would you be doing for me that I'm not doing on myself? Right. And there probably are some. Like, there are things that we do in our practice that I wouldn't do if I didn't have all the software and scalability to do it. If I was just doing this on my own with an Excel spreadsheet, is that enough value to warrant paying our annual fee if that's the only thing? I don't know. That's a lot hard. I think it's very hard to convince a DIYer to hire an advisor if they know how to do everything themselves. It's like, right. I'm not going to promise you I can beat the market. I'm not going to promise any of this other stuff. So it's going to be very subjective value typically. But if someone's already made the decision to hire an advisor, it becomes a lot easier because you can kind of equate price, and then you can look at, it's never apples to apples, but like, where am I getting? And I think, sometimes it becomes obvious, where there's a better value than others. So.
Agree. All right. So we're all ever learning. There's always tax legislative changes. There's always new things to pick up. So where do you two go for good content sources about retirement, financial, tax stuff, et cetera?
It's all over the map for me. I have a very eclectic group of interests and places where I research. I will, as much as we use passive index investing, I will follow all the, current events and global macro stuff. I read the academic studies of, what's the latest research in terms of retirement planning. And, there was an interesting one last year that the conclusion was that the safest portfolio, if you don't know where you're born and in what time period, to own 100% global stocks. Now, we don't recommend that to anybody, but there was some interesting takeaways about why, if you actually kind of dig through. I'm, with my CPA background, I'm pretty involved with the American Institute of CPAs, which they've got some very heavy stuff on estate planning and tax stuff that I enjoy. Obviously we follow Michael Kitz's. He's kind of the primary technical guy in our profession. Study group. Yeah,
study group. Like, having other people, I think we have the benefit of having each other and having two advisors to always just kind of, do like a quick holler over, like, hey, what do you think about this or whatever, but also having like, more formal study groups and other people to run things by. And what I always come back to also is just like source documents. So like the IRS, and just sort of like actually going to the source document.
Partially because we don't trust people. We want to see it ourselves.
Right, yeah.
Like, it's helpful to have other people's interpretations of things, but like at the end of the day, you need to go to the source to be confident that you have the right information.
Yeah. And that's, I think I've said this in different ways before, but there's so much good information about taxes out there direct from the IRS through all their publications. If you want to get really technical and nerdy, there's like revenue procedures and private letter rulings and stuff. But even tax legislation itself. Now, this is hard to digest, but like when I forget all the acronyms, but ARP, American Recovery Plan, and the Secure Act and stuff like that. Like, it's one thing to read different advisors' views or interpretations or summaries of it, but this is all publicly available. You can find the legislation. You can read through it line by line. If you have the willingness and ability to read technical legal speak that has references to the Internal Revenue Code, the tax code, like, you can see this all firsthand, what exactly the politicians wrote and said in this, these things. So I agree with you 100%, Mary. Go to the source documents. That's the smoking gun. It's sometimes hard to digest those, but that's the indisputable proof of this is what the thing actually is.
I think that's really important, actually, because there's certain tax legislation. Somebody initially writes an article that ends up on a mainstream media website, but it's often viewed through the lens of a certain audience, a certain demographic in terms of wealth and income. And it could actually be a very different set of, conclusions for a higher net worth person or someone in a different situation. And that stuff just doesn't get talked about because, the initial article that someone wrote with this, and then everyone piggybacks off that.
Right.
And I can think of numerous cases where we've gone through the source document, like, oh, this is a nice little carve out. Like, this will be applicable to this person and this person. I haven't heard anyone else talk about that yet.
Yeah. Definitely. It's so funny how nerdy we just made this right now, talking about reading like tax legislation. And
and the reason I left the traditional CPA world was I was tired of reading FASBs, which are, for financial accounting. And now I'm reading the equivalent just in personal finance.
For individuals. Yeah. All right. So moving on now to some sort of practice specific things and how you two actually do certain things about retirement planning. We started talking about this already, but how do you know if someone's a good fit for you as opposed to just them? You being a good fit for them? I know life planning is a big part of it, like you said.
Yeah, we did talk about how it needs to be a good mutual fit. So I think our sort of introductory process is how we feel that out. So first we have an intro call with someone. We're just kind of screening for objective things. Is it an appropriate fee? Are services that we're providing actually a match for what you're looking for, what you need? Is the investment philosophy, are you good with that? And things like that. And from there, then we actually have 2 meetings with clients before we present them with a wealth management agreement to even work with us. So the first meeting is the life planning meeting, and that's where we're really getting to know them as a person. And the second meeting is a much more traditional financial planning meeting where, we're actually doing a financial plan using our software and sort of putting all those things together, identifying areas of opportunities for them or things that we would want to, work on. And I think that gives us the chance to see, who they are, if we think they'd be a good fit for our firm, but it also gives them the opportunity to see who we are, how we work, how we think, and to know, are these people who I really feel comfortable handing this over to?
Yep.
And the plans you do is it fairly full blown? Do they get a deliverable, or is it just something you sort of discuss and show via screen share to them?
For the most part, we just sort of screen share and discuss it, but we do have the deliverable, which I think I'd be okay to give to someone. I don't know. I guess I'd have to think about that. People haven't asked, but I think the hard part is it's because the financial plans are based on our assumptions, our investment assumptions that we're using in our plans. And so it sort of is this is the plan if you work with us. And I hope that people get sort of the overarching takeaway of are they on track, or maybe some different areas that we could focus on. But it makes me nervous to give someone a plan that we were planning to implement versus we didn't create it for them to go do themselves. So I don't know. It's not
ongoing client, whenever we do update our financial plans, we always give them the deliverable, but not because here's your plan, go read this and implement it. More of just to substantiate, here were all the assumptions. And also if we ever need to look back, if a year or 2 years from now, the plan we're presenting is wildly different outcome. It's well, why is that? We still have memorialized what those assumptions were, and we could kind of go back and see what changed. But I think our role, or our hope at least, is that you're hiring us for advice, not to just be the calculator. So let us interpret this and apply it to your life and tell you here's the things to pay attention to, here's the things you need to do. And yes, we've run all the numbers, there's a lot behind this advice, but hopefully you can stay out of the minutia, like let us deal with that complexity behind the scenes. But we do want to show you, like, we're not just making this up. We're not basing all of our advice on heuristics. We are actually looking at the specifics for each client.
Yeah. And I asked more so because I think it's rare that you two actually do a large amount of work while people are still just prospective clients. They're not clients yet, right? So you do in effect a plan for them.
But we should clarify there though, because we do, but we don't do the full blown financial. A lot of it is we want to go far enough that we get the core financial plan of like, how much can you spend sustainably through retirement, and what are the areas that need to be focused on, so that if they become a client, we can triage those, whether it's estate planning or insurance stuff or other stuff. We don't necessarily go do all that detailed work. We just go deep enough that we've identified what the issues are, so we can say, if we continue working together, like, here's the roadmap of what we're going to accomplish in the first few months, first year, whatever. But we don't necessarily have all the detailed answers yet. We will typically.
Yeah, but I think you're talking about like the comprehensive financial plan. Like the piece that we do is the sort of like long-term projections with what is sustainable spending and sustainable withdrawal rates and things like that. And that is the real financial plan that we're running.
Correct. Yeah.
Hopefully, providing people with insight. And also it's like, that's what we would do after they signed up anyway. And so it's just to us like work that we were going to do anyway. So we can just sort of like hit the ground running and keep going after they come on.
Yeah. I think what we want to show people is here's how we work. Do you want to continue working together? Not here's all the promises we're going to make, but you can't. How do you validate it? Like we'd rather just show them. Like let's start pretending like this is going to be a long-term thing, and then you can assess a couple meetings in.
Right. And I'll say it on your behalf, just for people listening. If anyone out there is already, the wheels are turning and scheming, like, wow, I can go get a free financial plan and not become a client. Like, don't do that, right? Only reach out to David and Mary if you have genuine interest in maybe actually working with them. Don't just use them for a freebie, partial financial plan, because that's be a good human. Don't do that.
Yeah, so. I think too, that's what I wanted to say is like, it's not that it's not a real financial plan. Like it is, but it's not going to just be like, oh, I can go talk to them instead of go work with like an hourly or a project planner to get my financial plan.
It doesn't have all the action steps. And I mean, before we get there, we do the intro call. And like, if it's clear that we're not a good fit or that someone doesn't like, we probably aren't going to go to the next stage. And,
that's
quite
true.
frankly, it like our process requires a lot of input from them too. Like they've got to, go through, the life planning. They've got to pull together all their documents. They've got to do all this. And at the end, they're not getting, 5 pages of bolded action items to go do it. So like, I actually don't know that they would. I don't know that it would be a good use of their time even, because as Mary said, like we've set it up to say, here's the outcome. Like if you were to work with us, here's how we would do it. Here's what we think the result would be. But it's not set up for self implementation. So okay. Appreciate it either way.
Sure. Right. Yeah. All right. Have you ever had to, I'll call it, fire a client? And if so, why, if you're willing and able to disclose?
Yeah. So I don't know that we've ever really like fired a client, but we have transitioned clients elsewhere. And
meaning that it was very amicable. Is that the distinction there?
And like, it was just kind of the right decision for both of us because it's, with where our practice is and, we've grown more in the direction of serving, mostly retirees. So as context, when David started the firm, his background was in Silicon Valley with a lot of people who's, had company stock and trying to decide what to do when their companies were going public. And so that was working with a lot of younger people. And so over the years, focusing with retirees, we have transitioned people. And sometimes it's just that, maybe their company went public. We help them through the complexity of that. And then it's like, your situation's simple. Like you're young, you're saving, like you should go do this yourself.
We've had some that we've said, you are so cleaned up that like, we talked earlier about the values in the eye of the beholder, but we're saying like, I don't think we can continue to provide this level of value for the foreseeable future. Like you really should just go do it yourself. And when your life gets complex again, that's when you should look for an advisor that's the right fit at that point, whether it's us or somebody else.
Yeah. So either they don't really need our help or someone who really has the complexity and, they need like family office services. So we have had a couple of clients that were just like, I think you just need different services than what we're set up to offer. And so then they need to go find someone who can help more with that.
Yeah, I think the other, I don't know if you'd count this as transitioning, like when we kind of always had the vision of having a limited number of clients, the number we've had in mind is like 40, but we knew we weren't going to get those all on day one. So in the early years, we did a lot of project and hourly work that was always kind of intended like this will not be forever. And part of why we did structure that as hourly is we didn't want to lead people on that this was a forever relationship only for us to grow out of them. Like it was like, this is a, one-time engagement or a, reactive comeback thing. So, that I don't remember what year we stopped doing hourly work, but, those clients got transitioned to someone else. But
yeah, fire is a bad word. I should rephrase that. So I think transition's a much more accurate way of explaining it. So thank you for that. All right. Investment management. I think you already sort of said what your views are here, but what's your approach and views about investment management within your firm?
Yeah. At heart, I'm a boglehead. Like the core of our portfolio is passive investing and keeping it simple. But what we often say is like, we are passive, but not complacent. So we start with the global portfolio. Like that should be everyone's default starting point of, stocks and bonds and their proxy weights. But there are many reasons that you may shift overweight certain areas or exclude certain areas, but that should all be done very deliberately, and with intention. And so like, I think of the core of our portfolios look exactly the same as they did 10 years ago. And that's based on, pure beta, total US stock market, total international stock market. We also, are, kind of believe in the factor investing. And so we have small value allocations. Those have been there since day one. But a few things that have changed over time is we used to use, just total bond market. That was kind of the default standpoint. We used to use munis for, clients that were in high tax states with high tax brackets. And over time, through research and just our views and stuff, we're like, you know what? We view bonds as the safe money, and we use almost exclusively treasuries now, unless there's good reasons not to. And good reasons not to might be, they have investments outside. I'm thinking for a couple of clients that are still working where they're 401k and they don't have, a treasury. We use total bond market there. Or clients that have access to TIA traditional, which in some cases can be an awesome, substitute for fixed income. We use that. We typically are heavier using TIPS, Treasury inflation protected bonds, than I'd say the average advisor. And so that's been kind of an evolution. So there's been a few things that we've evolved over time, because although not much changes, like sometimes things do change. There's new products that come available. There are paradigm shifts in the world of how things work. And so we always, I spend probably way too much time researching this stuff for how many changes we make. But a lot of it is kind of the idea of we're standing guard, we plotted the course, we know where we're going, but we're still looking out at the horizon. And every now and then there is something that rises to the level of, maybe we should incorporate that here. And so, yeah.
And when you say you use mostly treasuries, I assume you mean individual bonds, not treasury bond funds, correct?
It depends. For the treasury inflation protected bonds for our retirees, we actually do use individual bonds. It's a quasi liability matching portfolio where we're building typically a 10-year bond ladder, so that essentially the next 10 years of their spending is, immune from whatever the stock market does, because it's in, US treasuries. It's immune from interest rate changes because we've tied, the maturities to each of those, next 10 years at 6-month intervals. And it's immune to unexpected inflation to the extent that CPI matches their personal inflation rate. For nominal treasuries, we typically are using funds just for simplicity of rebalancing. So it's a combination there.
Got it. Okay. Makes sense.
And I'll add one more thing, because approach to investment management. So David sort of has talked about the underlying investments and sort of products in the portfolios, but it's also managing it. And I think we have this incessant focus on tax efficiency. So managing things in a really tax efficient way. So asset location, tax loss harvesting, sort of how we're actually managing it on a day-to-day, week.
Yeah, we are very big on asset location, which means that we can't just set up the rebalancer and have it run auto, because it doesn't, as much as time I've spent tweaking the assumptions to try to get it to produce the trades I want it to, it just still doesn't. But that's an area that we focus a lot of time. And it's probably one of those things that, earlier we were talking about DIYers versus advisor, the tax loss harvesting and the asset location is much easier to do at scale and with this type of software that we have available to us than it would be if you're, checking your portfolio once a quarter and doing it in Excel or by hand. And so those are things that I think are easier to do the way we're set up.
Yeah, agreed. Do you benchmark your returns? So you invest clients in whatever combination of things you use. Do you then compare that and say, hey, look, the benchmark or sort of standard return would have been X, we returned Y?
So no, not really, for a couple of reasons. Yes and no, but formally no, because our goal like our investment approach is not to beat the benchmark. Like our asset classes should be the benchmark just because of the way that we invest.
Right.
But by that standpoint too, like it is important to know what things like the market is doing as a whole and how each asset class should have performed, and making sure that the funds that we're using are performing in that way. Because if they're not tracking with that, for better or worse, like we need to know why and see if that is an issue or not. And then I do think it is, though, a relevant question for clients and consumers to sort of look at, because, at the end of the day, all you care about is, does your portfolio support the life that you want to live? But you should also be getting your fair share of the market return. Like, you don't shortchange yourself. You should be making sure that you're at least getting what the market is doing.
I think that my issue with the idea of benchmarking is typically it's not done properly. Everyone compares, their balanced portfolio that includes international stocks, U.S. stocks, and a bunch of bonds to the S&P 500 and wants to know why they're down. Well, I can show you why you're down. International stocks didn't do as well as the U.S. this year, and bonds most years do worse than stocks. But that doesn't mean like you didn't win. Your portfolio did exactly what it was supposed to do. Because if you look at each of those components, like they did what we expected them to do based on the risk exposure we wanted. And so I think it's relevant, but often people get hung up on the wrong thing. But I would equally am hesitant, the advisors that, say, oh, never compare it to a benchmark. All that matters is that you're meeting your goals. It's like, well, yes, you should be meeting your goals, but you also should be doing as well as you could given your goals and given the ingredients you're using. If you're using funds that are way too expensive, like you may still be meeting your goals, but you could do even better with no additional risk just by using the cheaper fund.
Sure.
And so it's a nuanced answer of, and we do show, like when we do our annual reviews, like we'll kind of give some market commentary and show, here's what the US market did this year, here's what the international market did. And then on the next slide is their personal performance. And we break out, the asset classes to kind of show the attribution. And like, hey, look, the two biggest asset classes you have are US total market and international target. Look how close they are to the prior slide. Like that's exactly what they're supposed to be doing. So in that regard, we do, but we're not hyper focused on it.
Yeah, I agree. It's good to know what the relevant indices or benchmark are doing, if nothing else, just to make sure you are still using funds or products that are as good or as efficient or as cost effective as they can be. But outside of that, trying to compare a given client's account return or portfolio level return to some benchmark arbitrary number is like, I don't know that there's much value in that.
If you focus too much on that, you end up just chasing whatever's done well recently. One of the other kind of quotes I love about investing is like, the most important thing about an investment philosophy is that you have one. And having a consistent investment philosophy, like there are definitely some bad investment strategies out there, almost objectively. But then there's a number that are like, what is the right percentage of international stocks? Like there's a range at which I could be convinced.
Right.
It's probably more important that you think it through thoroughly and then mostly stick with it.
Exactly.
And the worst thing is to switch. You could switch if you switch between a bunch of decent strategies, you could actually end up with a bad outcome. Just decide what you believe, know why you own it, and try to stick with it through thick and thin. I
fully agree. Whether you're 60-40 or 65-35 or whatever, 55-45, like that doesn't really matter, right? It's going to give or take kind of wash out the same more or less. But whatever you pick, make sure you intentionally thought it through. There's a reason why you have that allocation to stocks versus bonds versus US versus international, and stick to it. Because once you start folding in, oh, well, this market did better than this market this year, let me change my strategy. Like, no. That's dangerous.
Right. Know what you own and why you own it is really important. And if you're not sure why you own it, then probably the right default is just total market, pure boglehead strategy. Don't deviate from that unless you know why you're doing it.
Yep. Make sure there's a good reason behind it. All right. Annuities. So you two are fee only, like you said. You do not have insurance licenses. You cannot sell insurance products. What's your view, usage, thoughts around annuities and clients' usage of annuities?
In general, like as a heuristic, we don't like annuities, but there are circumstances where they could be the right product. I think the reasons that we tend to not like them are just that it can reduce your flexibility with your financial plan, and also the risk of inflation, is real for retirees. Interestingly, though, just this last year, we did sort of have the first time where we actually recommended that a client purchase an annuity. And it was just a really particular situation for their circumstances. So, she's recently retired. She has a mortgage, which, ideally we like for our clients to, be don't not have a mortgage in retirement, but she had a mortgage. And she was a university professor with her TIAA, 403B. And because she had this mortgage locked in at a really low rate, and TIAA had this annuity option that she was getting, I think ended up with everything like a 9 to 10%
payout rate. And if you back out the like mortality credits, it was still like an implied interest rate of 6% or so. And it was an arbitrage.
Yeah, just interest rate arbitrage.
Let's annuitize just enough to cover your mortgage. Because it was kind of one of those situations like paying off the mortgage would take away flexibility and optionality for her financial plan. We didn't like it. It's like, hey, this way we can completely defease that liability by kind of liability matching and get extra. If we instead took that money to pay off the mortgage, we'd miss it on the extra interest.
Yeah.
But I think that's the only case where we've recommended buying one.
We do have clients who come to us with annuities, and then we can help look at them. And, sometimes it makes sense for them to surrender. And, we've also had several cases where once they already have the annuity and we look at the options, it's like, hey, it actually makes sense to annuitize this thing and keep it.
Yeah.
So.
Yeah. As a general heuristic, I don't like them for the reasons, Mary laid out. I think the reason people are attracted to annuities or they're able to sell them is it has the appearance of reducing uncertainty. Hey, don't worry about the volatile markets. Like, we can give you this guaranteed thing. But what they're missing out on is that, yeah, you've narrowed the range of outcomes, but you've also pushed it to the bottom of that range of outcomes. Like that probability scenario, the worst case scenario there may still be better than the now guaranteed scenario with the annuity. And you've lost all flexibility. Like, what if inflation, what if we do have unexpectedly high inflation? Now you have no options here. And so, yeah.
Yeah, that's a good point. I mean, there's lots of different annuities in different forms and fashion. So it's kind of an unfair question to say, what do you think about annuities? But I think generally people assume, and this is what my intention is when I ask this question, is like the use of annuities that produce guaranteed income is what most people think about and apply it toward. And to your point, like you said, Mary, vast majority of them don't have inflation increases, or if you do buy some sort of quote unquote rider that does have an inflation increase, like you're going to pay for it. You're going to get a smaller payment upfront or have to pay much more initially to buy it. So while the amount you're going to get could indeed be guaranteed in nominal terms for the rest of your life, if you're alive 30, 40 years, and think about what 30, 40 years of inflation can do. If you're getting $1,000 a month now in annuity, it may be good now, but in 30 years, that's going to be equivalent of what, $400 maybe, give or take? I don't know.
Exactly. So, and I don't even know if there are any, and I know there used to be some annuities that had like a CPI riders. I think most of them now are just a locked in number. Well,
right.
That's not a risk. You can plan for that. If we knew inflation was going to be 2% or 3%, that's something you can just bake into the plan. Like, what we need is insurance against unexpected inflation. And the only way you get that is tips and Social Security.
Yeah. So, I mean, this isn't to say annuities are bad. I'll be the first one to say they're not. I think there are cases where it definitely makes sense, but they're not as riskless, low risk, guaranteed as they may imply for things like inflation, if nothing else. There's still that risk, which is very present with the vast majority of annuity products.
Which is why it worked in this one case, because the liability we're trying to defease was a fixed rate mortgage. We didn't have to worry about the inflation there, and we could just completely match it up. And I guess the only thing that's left is the risk of, TIA going under, which
we got bigger problems that happens.
Yeah, exactly.
So there's that's a good point too. There's always that risk when you have an annuity from someone. You are facing the claims paying ability of the insurer behind the annuity.
What's a guarantee? A guarantee is just someone promising you.
Yeah. Now, to be fair, major insurers, those that are well rated, I don't think there's many, if any, cases of those going bust. Or if they are in trouble, what usually happens is other insurers step in and buy out their business.
Right. Yeah.
Because it's a real black eye in the whole industry if a major insurer were to go under. So like the rest of the industry doesn't want that to happen. So in my view, I think the risk is usually pretty small of having to worry about an insurer going bust, unless you buy some, like Uncle Gino's fly-by-night insurance and whatever, then you got to worry. But the major names that have been around forever that are well rated, I think the risk is tiny to the point. It's virtually non-existent. Trusts. This is another hot topic. There's lots of discussion around, do I need a trust? Some people say everyone should have one. Some would say absolutely not. Now, I'm talking just about the living revocable trusts, not the special kinds like, insurance trusts or special needs trusts or whatever. But what's your view around living revocable trusts?
Yeah. So again, the context of most of the clients that we're working with have a few $1 million. They tend to be kind of like private people who want to leave an orderly estate for their heirs. So I would say we're generally in favor of revocable trusts for our clients. I mean, it's not to say they always need one. And, sometimes they might not even need a revocable trust. They might have a testamentary trust, where just through their will, they're going to create something for their heirs. But at the end of the day, it is super state specific. And that's really something to outsource to the estate planning attorney. And, we defer to their expertise. But how we get involved with that process for our clients is, they go work with the estate planning attorney. We like to see the draft documents before they sign them so we can read through everything, we summarize it, and then we in plain English talk to our clients okay, we read through your documents. This is our understanding of how everything's going to go, because we want to know what their plan is too. And then they can either say yes, that aligns with my wishes, or no, that does not align with my wishes. And at that point, if it doesn't, we need to talk to the estate planning attorney to see, did we misread something, or do we actually need to make changes to the documents? So.
Yeah, I think again here, it's balancing the simplicity with the benefits, and, and that whether that's a testamentary trust or a revocable living trust. But, a lot of our clients want to leave relatively simple situations for their children. And so while the default may be, we'll just give them the money outright, with modern trust, there's ways to pass it on to your kids where they can be their own trustee and still have credit protection, still have outside of their estate. And so there's often ways that you can get pretty close to the best of both worlds. There's still a little bit of added complexity, and I think considering that is worthwhile. And I think a lot of our clients, after thinking through it, are yeah, that's worth it. And then the question is just, do we title everything in the name of the trust today, or do we do transfer on deaths so that we don't have to deal with, trustee signatures, and we can keep everything really simple? And I think those are all valid considerations. And that's where I think we also can play a role. A lot of the attorneys are, living in kind of textbook world where, just do this and we can do that. And then it's how are you going to fill out this form to go open that account with that crazy thing you just did?
Right.
Let's think through this operationally. We want to keep this pretty simple. And I think that's where we can provide some value too
Yeah. So you're not lawyers. You don't actually draft and execute the trust, but you can very much help. You can help.
We read a lot of trusts though.
Okay.
That's one of those areas that I spend a lot of time in researching, even though very little of it gets applied on, a day-to-day basis. I enjoy the estate planning side of it.
Yeah. It's important to know. So that's good. Long-term care insurance. This is another hot topic. What's your views and philosophies on, should people consider it? Should they not? What are their alternatives?
Yeah, so I think it's important conversations to have to know what someone's plan is ahead of time. But again, with the level of wealth of our clients, they're typically self-insuring unless they happen to have purchased a policy, over a decade ago that has really favorable terms, because, we do have an, independent broker who we send clients to have their policies reviewed or to look at the options. But it just seems like these days the policies out there don't seem to be making sense for our clients.
It's almost similar to what we were talking about a few minutes ago with the annuities that have the, inflation riders that are just a locked-in percentage. You want to buy insurance for those tail risks. And most long-term care policies, they have a cap on the amount of benefits that are available. It's you haven't insured the tail risk. You're still having to self-insurance tail risk, which is the whole thing that I'd want to give up. And so if you're in a position where you can self-insure, that's the simpler option, and you're probably not worse off.
Yeah, I agree with that. This next question could go lots of ways. It probably shouldn't be boiled down to a single question, but what's your approach to putting in place a distribution plan for clients?
Yeah, I mean, we talked earlier, tax efficiency and just tax planning is a thread through kind of everything we're doing. Our goal is to minimize taxes over your lifetime with the ultimate goal of, maximizing your wealth after all those taxes and fees. I know there are some special distribution software out there that say, take it from the Roth in this future year and this, maybe we just do it too manually, but we do long-term tax planning of looking at here's, what your effective tax rates are, marginal tax rates are now, here's what we expect to be them at all the phases for the rest of your life. And trying to say, where are we relative now to that? And should we be doing Roth conversions here? Which account should we be taking this out of? And so we're doing broad level planning to know directionally what to do. And then on the given year, we do very precise tax planning and try to, maximize all those opportunities there. So it is something we focus a lot on, but we don't have some fancy reports and software. It's a lot of, spreadsheets and looking at it from different angles. And And then at the end of the year, we put together a tax letter and send that to the CPA to make sure that all the things we did, whether it was Roth conversions or QCDs and all that stuff, gets documented properly on the tax return. Because I think that's another thing that we've seen. I mean, despite sending a letter saying all these things, I review almost every single return. And the rate at which I have to say, hey, you forgot this is way too high. So
you don't do taxes, correct?
We don't prepare taxes, although every year I get that feeling of, geez, with the amount of time I'm spending reviewing this and catching all this, maybe I should. And then, I've got a bunch of friends that are CPAs and do taxes. And like, no, David, don't do it right now. You're the hero for finding all these things. Like, tax preparation is not fun. I'm like, yeah, that's right.
Yeah. I have mixed feelings. I agree with you that there's days where it's like, I should just do it. And you probably can do it much quicker and more efficiently than farming it out and sending out 1090, tax letters to other people and have them to wait on their terms, whether it's a week, 2 weeks for them to get the return done. But it could be a big time suck if you let yourself get too carried away in doing taxes.
Well, that, and it's like, then we're really good at the things that we focus on and we know, but sometimes clients have other things going on outside of our area of expertise, and it's, not areas
the tax code is really broad. And although like we do know certain areas of it really deeply, I think often more deeply than some of the tax preparers, there's a lot of stuff where I would completely just defer to the taxpayer and say, I don't know. Like, we don't do a lot of stuff with complex real estate, depreciation and all this stuff. We don't do a lot with, I guess we do have a couple of retirees that still have businesses. And so
retired.
they retire to, to start a new business. It often turns out. And so like, we're careful of where we focus on taxes. Like, we only want to focus deep on taxes where we know we can add value or where we think that this tax preparer, it doesn't have it handled fully.
Yeah. And did you do taxes in your prior life, David, or it was more like it was more on
the financial accounting, the audit side. Okay. So, I had to take all the tax classes in college and am very comfortable reading all that stuff. But no, I didn't work as a tax preparer for years before this. Okay. I almost did. When I decided to leave financial accounting and wanted to move into wealth management, the CPA firm I was at, they had a high net worth tax practice, and I had gone and talked to the managing partner there and to see if I could join his team. He gave the approval, and my audit partner said, "You've got to go through one more busy season before I let you move, divisions." And in the meantime, I had put out some feelers out there, and I got an opportunity to work at a wealth management firm that's doing exactly what I ultimately wanted to do, i.e., this. And so I went straight to that.
Good, and it all worked out well. It sounds like.
Yeah.
I think I know the answer to this, but circling back to the distribution plan thing, do you, just because multiple people have asked within the Facebook group and stuff, is there a formal deliverable you give to people showing the distribution plan, be it current year or longer term?
So it's like a yes and no situation, because for our clients, we run their financial plans and sort of do like the high level, what can you sustainably spend? And so we're reviewing that with them every year, and we're really trying to distill it down to like the major key takeaways for them, because they're sort of delegating to us behind the scenes, like, okay, I want to spend X amount of money, and we're behind the scenes saying like, okay, here's the most tax efficient accounts to take it from, and things like that. So we, in our conversations and our meetings with them, we really distill it down to, a couple of key pieces of information. But we also, we use eMoney for our planning software, and that spits out like any report that you want. And it can be, like dozens and dozens of pages. And like David was saying earlier, we do run those reports, and we've kind of narrowed it down. So we've got it probably down to like, 30 or 40 pages, which is still a ton, but it does show like year by year cash flows and what that looks like. And we do provide that to our clients. I don't suspect that many of them look at it, but sort of we provide it out of like full transparency, that if they did want to see it and they did want to look through all those things, they could. And then also that, like David said, we sort of have that historical record of like, this was the plan. And if something changed, like why is the outcome different than what we expected? And
like specifically like which account stuff would come out of in the future. Like to me, those reports are about as potentially even more worthless than the future cash flow projections, because it's like, it's good to have a general sense of like during these years when you're in a lower tax bracket, you might be taking more of the traditional IRA versus this, but like you've got to drill down into it when you get to that year and be far more precise. And so knowing that 5 years from now, I'm supposed to take it out of this account, like I can promise you that's wrong. If the report looks really pretty,
Right.
like we'll get into the nitty gritty. Like I love to optimize the taxes. Like I get so excited our clients that where we manage like all of their money and I can, do their tax projection down to like really close margins and be confident that we're not going to blow through an IRMA limit because I can maximize that Roth conversion or something like that. So
Yeah, we still think alike in this, and same thing. I use eMoney as well in my firm, and there are reports that can show in year 3, 4, 5, 10, whatever, take this much from this bucket of taxable money, this much from Roth, from whatever. And I tell clients like, no, and it's almost uncomfortable to say. It's almost like that's going to be wrong. Let's not do that. That's good for directionality, magnitude, broad stroke, whatever. But we're going to figure it out year by year. It's almost like saying, just trust me. Like each year is going to be different. We'll know the answers in that year. Each year is going to look not the same as it was in the prior year. Trust me that when I say each year, we're going to iron this out precisely.
Yeah, exactly.
And clients that have been clients for a while see that and are now comfortable with it. But like newer clients, it's like, I can see them getting uneasy telling someone something like that. Like, don't worry, we'll figure it out. But that is the real answer, right? Like,
yeah, I think it sounds like we just like I try to give them an idea of like, based on where we stand now, this is the general direction I think we're going.
Right.
But that's not the plan that we're just going to execute without reevaluating it when we get there.
Yes. Yeah, agreed. All right. Tax planning. What are some common opportunities you often come across with your clients with regards to tax planning?
Yeah, big ones would be Roth conversions. Like I know they're a hot word, but I do. All else being equal, we love Roth. We will often do small conversions for people that don't have them right away, whether it's a nominal like $100 just to start, 5-year clocks. My view with Roth is, do no harm. Like if all else equal, I can have it in a Roth over a taxable account, or I know I can I would prefer that. It reduces the future uncertainty. A lot of why people do financial planning is because they want certainty. Well, you never will get certainty, but there is a lot we can do to reduce uncertainty or, certain bad scenarios and knowing, not having to leave open the question of what future tax rates will be on ordinary income reduces one of those variables. But just categorically saying you should do Roth conversions, Roth is good without taking all those tax expectations into consideration is also foolish. So we focus a lot on Roth conversions. We do a lot of QCDs, 529s for grandkids. And then on the investment side, I think we talk about asset location, tax loss harvesting, occasionally gain harvesting. For most of our clients, that's not really relevant. They're already out of the 0% brackets there. But
okay. How much do you get involved and do clients do large charitable giving where you're having to like set up donor advised funds and figure out like batching together donations to maximize deductions and stuff?
Yep. We do that particularly if they're not QCD eligible. We do a lot of donor advised funds.
Okay.
Because again, for us, it's we like to keep things as simple as possible. And donor advised funds are like, actually, once you have them set up, they're like super simple. And it's so great that you can just like log in and send the money to charity and you don't have to track it for your tax return for what to deduct or whatever. Yeah. So it's like, you just kind of like take the big lump sum in the 1 year. So,
and I think it can be really important to consider that before if we take on a new client in their portfolio, before we, start restructuring everything, like sometimes they have some random individual stocks that have done amazingly well and they've kept because the capital gains are huge and they don't really want the stock anymore, but they don't want to sell it. Oh, but you have charitable intent. That's the perfect candidate for a donor advised fund. And so we do want to evaluate that before, we were to sell it or something like that.
Definitely. How do you balance trying to optimize plans without getting unnecessarily complicated and focusing too much on small things? Like it's a hard balance of you want to be as right as you can be. You do want to try to nail things down, but there's some point where it's like diminishing returns and you're just chasing after perfection that doesn't exist type thing.
Yeah. And it is a hard balance because we like to nerd out and go deep on things. And so, we like to optimize. And to a certain extent, I do think by working with a financial advisor and paying them money, you should be doing some of those things to optimize. Yeah. And so a lot of the things that we can do behind the scenes that we can take on that complexity for the clients to optimize. And, again, individual bond ladders for clients, that's a lot of work that they can delegate to us that may not make sense if you're just doing it yourself or something like that. But in general, We definitely err towards simplicity. I love the quote, like, simplicity is the ultimate sophistication, because, you have to sort of work through that complexity to get to a really simple, sophisticated solution, but like you said, balancing with the fact that you don't want to make things too simple, like you need to hit that balance.
Yeah. Which is hard to do. And it's a sliding scale, and there isn't like an obvious tipping point or balance point, fulcrum point in nerdy physics terms for most people.
Yeah.
Yeah. And in practice too, I think sometimes it's only in hindsight that we realize something. Like, we'll do something for a client and then we're like, oh man, that, like, they were confused. That was so much work for us. And like, it didn't add that much benefit. And like, that was a mistake. We're not going to do that again. So sometimes it is like trial and error too.
And I'm just curious, you tell the clients, like, listen, I'm sorry, we really overthought and over-engineered this, and we're going to pare it back, and here's why.
I'm trying to think. Oftentimes
I think the issue is more that it doesn't necessarily come to a complex ongoing solution. Like, we don't do things that would be the ongoing complexity.
Okay.
It's just the process of going through it was like not worth the final outcome. So it's like, we're not going to do this for another client because it was not a good process for anyone.
Yeah.
Yeah. I can think of things that we've done and then we're like, yeah, that was not worth it for them or for us. Like, there is a distinction here. Like, if it's complexity that falls on us that we can do behind the scenes and the client doesn't have to deal with it, we're more likely to do that.
Okay.
If it's going to require a lot of interaction for the client and the heavy lifting of the client, we're more careful of like, is this really worth it for their time? Like, most of our clients are hiring us to delegate it to us. And so we then do try to quantify, what is the value here? Or is there another solution that would be way simpler for them and gets us almost just as far there, and they don't have to worry about any of the details?
Yeah. Okay. Got it. Here's a big one. How do you help clients determine if they have enough for their retirements? It sounds like in many cases, their clients higher net worth, they probably do. Objectively speaking, might be a fairly easy answer, but for those where it's not so easy, what's your process to figure that out?
Yeah. So I think a lot of it comes back to like the life planning goals, and enough is a different number for everyone. So yeah, like many people would be like, oh, people, you have $2-3 million. Like, sure, you have enough. And it's like, it depends what your goals are and what your spending is and all of that. And so I think that's then really important to tie into the financial projections, and the way that we think and the way that we plan is we use fairly conservative assumptions relative to probably the average advisor. But, we think it's more on the realistic side of things. And then also just like running their financial plans every year to seeing if they're on track, seeing what the trends are, keeping them accountable. So like one of the things that we do for clients, like I said, we give them just a few kind of like bottom line pieces of information, and it's what is a sustainable withdrawal rate? And it's looking at like, for example, in a given year, but then we look back historically and we're like this year for 2024, we're like, okay, here's what you took out of the portfolio in 2023. Here's what you took out of the portfolio in 2022. So we can kind of see, are you actually living to that plan?
Yeah. And for those on the other end of this question, for those that don't have enough through whatever, means you help figure that out, what do you often or typically try to do to manage, communicate, change?
Yeah, so we don't have as many of those conversations as we do with like the really fun part of life planning for us is like working with the people who do have enough. And because that I think aligns with our personality. And I know there's a lot of people, like the die with zero and sort of like spend as much as you can during your lifetime. And I think that just my personality makes me nervous, and like the way that we plan, like we're fairly conservative people. And so that just like jives with the types of clients that we work with and that are a good fit. So we can kind of, do things like encourage them to, maybe take their family on that vacation that they've really been wanting to do, or like do things around the edges. But I don't think we're ever going to be the advisors to really push them to spend more than like they're comfortable with at the end of the day.
Or that we're comfortable.
Or that we're comfortable with, because so I think that's part of why we don't have those conversations terribly often, just because it goes back to like the who's a good fit for the clients. But we do have those conversations when we need to. And I think it's just about being honest and transparent about like, this is the reality of your situation and what we're seeing. Because at the end of the day, like they're in charge of their own life and their own money. And so it's like giving them the information and also then brainstorming ways that maybe this could be solved. So pathways that they could get on track, like, if you adjust your spending down to, by a certain amount, or maybe they have a second vacation home that's like, hey, maybe in your 80s, you're going to have to, consolidate to one property, or just kind of thinking through what those hard situations to make adjustments down the road would be. But just like, we want people to have a successful plan and know that there is a successful pathway for them.
Yeah. And going back to those that do have enough or more than enough, you said you wouldn't push someone to spend more than they're comfortable with. But if it's obvious they have so much more than they need that they really should, or they're going to, pass with a lot more than what their goal was by far. How do you use like life planning, or what do you try to do to show them or get them comfortable with that? Again, I know you don't push them. You made that clear.
Yeah.
But like,
well, I think two things. So part of the reason I think we wouldn't push them is because one of like some people's major things is like having that peace of mind and just feeling like, I know I could afford to do this, but I actually get so much more satisfaction out of like knowing that I can, but not actually doing it. So for those people, like, that's great. And if they have legacy goals, or like they'd be happy to leave it to their kids to, make their, the lives of their children or grandchildren easier, like to me, like that should be honored, and that's fantastic. But by the same token, it is like, okay, family is really important to you. And you talk about how, like we have this one client who, when we were doing the life planning, they're like, oh gosh, we would just love to have a lake house because we love going out to the lake. And it'd be so fun to have all of our family together and like invite the grandkids out. And they had pretty much all of their spending like locked in with, pensions and Social Security. So like everything that they had was, they did have enough pretty clearly. And so then it was like, okay, like, what do you think that lake house would cost? And it was a number that they could absolutely afford. And then we're like, encouraged them to do that.
Yeah.
They did go and buy the lake house, and they still are like, oh my gosh, I'm so thankful that you guys told us that we could buy this lake house. Like, it's been one of the greatest senses of, joy for our family.
Yeah, I think we do pretty good with anxious clients that are worried about it, because that's not that far from our own personalities of like wanting to, like, we don't want ourselves to live in a lifestyle that we don't think is sustainable, indefinitely. And I think many of our clients view that similarly. So similar to how earlier I said with the investment portfolio, like everything is in there for a reason. It was very deliberate. Like that's true with the assumptions in our financial plan. Like, so although we don't shift our investment portfolio based on what we see going on in the markets, we do shift our assumptions. So like when something goes up double in price, all else being equal, the return has now been halved. And so we will adjust, like our return assumptions, I think, are lower than historical and lower than the average advisor. And as we walk clients through this to show you really can be confident that you can spend this money, we're able to walk through them why. And it's not just a black box and here's the up. Well, I don't know, the calculator says you can do it, so you can do it. And we can explain, no, here's why you could do it. And we've tested it through this time period and this time period. And like, there are no guarantees, but you can probably afford it. And here's how we would know if like that situation changes. And here's what we could do to make sure that you get back on track. And I think often we're actually able to connect with them because those are our values too.
Yeah.
So we won't do well with the people that want to die with zero. Like if it's like, I want to die with, then like it probably isn't going to work, because the way we plan to make sure it's sustainable means you most likely will have money left over. So
I read that book last month, 2 months ago, and I thought it was interesting. I thought it was thought provoking, and I would recommend reading it for the principles and to use your words, Dave, like the directionality of thought with it, and the concept of if you know you're going to die with money left over, and you know you have kids or charities or friends that could benefit from it now, why make them wait till you're gone? Be it 10 years, 20 years, 30 years from now. Do it now. They'll get more use and enjoyment out of it now. You being alive will probably get the benefit of enjoying and seeing them using it. So fully agree with that concept. And I incorporate that as well with people I work with. But the actually dying with zero, like the literal target of trying to die with zero is like, oh man, that just makes me so uncomfortable.
Yeah, I'm with you. Yeah. The ultimate objective is to have the best life possible. And so we don't want you to be always worried about money because you think you're spending too much, but we also don't want you, like, the objective isn't to die with the biggest number. And so what are those things you want to do? What are those values? And like you said, if you can do those during your life and have the grandkids around, that's ideal. And we want to support that. And we want to give you confidence that you can do that if we are confident that you can do that.
Right. Yes, exactly. All right. Getting towards the end here, wrapping up. If you could give only one piece of advice, and this is to consumers, listeners, not advisors, about words of wisdom, retirement planning, what would it be?
I think a lot of it is trust your gut. When something seems too good to be true, it often is. When, it doesn't feel like the right fit, it probably isn't. Always err towards simplicity over complexity. And ideally, figure out how to structure your finances either on your own or with an advisor, such that you're not having to worry about it all the time. You have enough confidence in the plan, you know how things are coming through, that ultimately you can focus on the things that bring you the most, joy, whether that, is your health so that you can live a long life and enjoy those things. And for often people, it's family. And for some retirees, it is going to be the investments and they like it. And those are the DIYers, and that's fine too.
Right. Agreed. Well said. Mary, anything to add?
I don't think so. We talked about this ahead of time. So I think my big thing was, keep it simple. I think, like, don't make your money the focus of your retirement unless that's what you want to do with your time.
Okay. And one more question. I keep telling myself I'm going to cut this out because it seems like such a chumpy question that I'd struggle with if I was asked, but I'm curious if you have an answer. If not, no big deal. Is there anything you think I should have asked but didn't to you all?
Yeah, we thought you were going to cut this one out.
Okay. I can cut this out of the episode.
No. I think broadly speaking, we covered a lot of ground. Like, there's certainly areas that we could have gone deeper into and probably could have done a whole podcast on. Like, it probably came through. Like, I really enjoy thinking about the investment side and how to build portfolios that can withstand, hopefully anything that's thrown at it, or whether it be, as much as I'm hesitant to blanket say Roth conversions are great, like, I'm a big fan of Roth, and we've done a lot of analysis to show even often for people who are in high income tax brackets, it can make sense to do Roth for various reasons, whether it's because they're paying with it with outside dollars, or because of for estate planning purposes, or whatnot. We can go deep on a lot of those areas with the taxes. So there's more depth that we could go to, and maybe sometime we can do that. But broadly speaking, I think we covered.
Yeah, but I think we've talked enough already, and you've been a really gracious host, and you're super generous with, your time and your knowledge and your expertise. And I know you've helped a lot of people, both, advisors and consumers. And so just thanks for all of your work and making such an impact.
Oh, thank you. And you two are great. I'm glad to get to have known you, and you're definitely allies in my world, and clearly we think alike and approach things alike. So it warms my heart that folks like you are willing to come on and share, and we can just sort of build community, because we're all relatively small firms, but all think alike. And I'm convinced the way we do things is the way of the future, and the advisory industry is going to keep trending toward our sort of service models and approach and views around tax planning and fee structures, and being small and intentional. We're going to see a lot more of folks like us popping up. So
100%. Yeah. Thanks for carrying the torch. You've got, there's a lot of consumers and advisors alike that, you've made a big impact for.
Which is interesting, because I had someone tell me the other day, like, this podcast is weird in that it's not clearly focused towards consumers or advisors. It's like sort of both camps can sort of equally get some decent info out of this.
I've loved listening to your episodes where you have like real people doing their, retirement planning. I'm like, I love those episodes. It's so cool. I learned so much from them too.
Yeah. 100%.
I think you asked about places where we get research. There are many times where I go to the Bogleheads forums, for example, to research a question, because there's some incredibly bright DIYers out there. That I'm like, I hadn't thought about it that way. That's perfect. And that may be a better source sometimes than other advisors or written stuff we find. So it is a cool community you've built that kind of brings those two worlds together.
Awesome. Well, thank you. And if people wanted to learn more about you two, your firm, where should they go?
Yeah, we're not very active on social media, so probably the best place is just our website, laminarwealth.com.
Okay. And I will have a link to that in the notes of this episode. All right. Mary, David, thank you very much. It was great talking with you, and I appreciate your time.
Yeah, thanks, Andy.
Thank you, Andy.
All right. Take care, all.